Welcome to the GRadulting Workshop Series. My name is Debbie McCuskey, and I am the Coordinator of Services and Programs for Graduate Student Legal Aid. And today, our focus is taxes for international students. So you may feel overwhelmed when you consider preparing your taxes, but I want to assure you that there are many resources available to help you through this process. We will share those with you today, as well as some basic information about tax preparation. Before we get started, I want to tell you just a little bit about Graduate Student Legal Aid in case we missed you at orientation. So what does legal aid do? Well, in addition to these workshops, we support students in 4 more ways. First one is legal consultations for students who have local issues, like problems with the landlord or a traffic ticket. The second area of service are legal consultations for those who have immigration issues. Third area is advocacy for students who are facing a Title IX issue or university charges. And fourth are notary services. So if you paid your student fee, then you paid for our services. There is no additional charge and no reason to not reach out and ask for help. So I encourage you to visit our website to learn more about our services, and there you will find instructions about how to request an appointment. So now for the rules of engagement for today. This session is being recorded, and we will share the recording along with the slides and all the resources tomorrow. It will be sent by email to everyone who registered. We ask you to use the Q&A feature, not the chat, the Q&A feature, to post your questions. And you may post your questions throughout the workshop. They might not be answered immediately, but we will get to them. Okay, let's move on and introduce our speakers. They are a dynamic duo who generously share their time with us every year to kick off tax season. First up is Professor Samuel Handwerger. He is a CPA and a lecturer at the University of Maryland's Robert H. Smith School of Business, and he is also the faculty advisor of the UMD-affiliated tax preparation service known as Terp Tax, and he will tell you more about that. So welcome, Sam.
Thank you.
Also joining us is Susan-Ellis Dougherty. She is the director of UMD's International Student and Scholar Services. She is always advocating for international students, and she is always joins us to share her insights and her support for students who are preparing their taxes. So, Sam and Sue, I'm so glad you could be with us today. Thank you so much for your time. Please take it away.
Okay, thank you very much. Welcome, everybody. We're going to go to my screen in 1 second. Our basic goal today is to understand taxation as it applies to international students, specifically under F1 or J1 visa. We can answer questions when we're done about any other visa statuses that you might have. We will mention F2 from time to time, but we're really looking at our international student body. And on that note, I'm going to go share a screen. We're going to talk about the general concept of taxation for you, our F1 students. Okie dokie. And we need to get, that's not what I want to show you, so don't look at that. There we go. There's what we want to show.
Pulling things
Yes.
up, I'll just say one thing about the Q&A. As people
Great.
put their questions into the Q&A feature, the feature does have a voting up of a question. So please feel free to endorse somebody else's question, and that will let us know that this is a question that many of you in the group have today. Thank you.
Yes, and since the information is cumulative to a certain degree, please feel free to ask questions, and I'll get interrupted and we'll deal with it at the time. Okay. All right. Having said all that, we're going to cover taxable income for F1 visa students, and we're specifically focusing on in the United States, obviously, because that's what we're concerned about, is that you have your compliance with your visa. Your compliance with your visa is tied in to what you do for tax purposes. Let me say that in a different way. If you are not compliant with tax in the United States, the status of your F1 visa could be at risk. So that's why this is of importance to all of you to make sure you stay compliant. And compliant means fulfilling your obligation under the U.S. tax code for filing returns or information returns. So the Internal Revenue Service, that is the IRS here in the United States, is the governing body of enforcement for the tax law, Internal Revenue Service, and so that they know where you are and what you've been up to. And on that note, just a real quick goal of helping you understand the U.S. tax system, which is different than some other systems around the world. The USA system is a self-assessment system, which applies to both you and citizens and residents of the United States. Self-assessment means the tax code tells you how to compute your tax liability, your tax obligation, your tax compliance requirements, but nobody's going to tell you specifically what you need to do. The law says, but you have to do it yourself. Nobody comes around and says, well, I'm from the IRS, let's file your tax return, let's take care of your compliance. You must do it yourself. That's what's known as self-assessment. Relies on the individual, both citizens and non-citizens, to tell the U.S. government what their requirements are for tax purposes and what their tax obligation is. Quite different. All right, so we want to understand F1 visa taxable income, non-taxable income, all the nuances of what F1 visa students must do. And on that note, what we're going to do is we're going to move to a broad view, see the forest before we see the trees of taxation in the United States. And on this note, what we're looking at right now is the concept of the fact that there is resident taxation, which will be on worldwide income. So who's a resident, that we're going to need to define who's a resident and who's a non-resident. Because if you're a U.S. resident for tax purposes, it has nothing to do with your visa, has everything to do with the tax law. So if you're a resident for tax purposes only, you're subject to tax on your worldwide income and your worldwide assets. That means that it is not very desirable to be taxed as a U.S. resident if you have significant income outside of the United States. Unlike other countries where you could go to that other country with a visitor visa or some kind of work visa, and you could immediately figure out how to pay taxes because you would be just like other people paying taxes on the source of income from that country only. The United States has this unique difference. Some other countries have it, but we're one of the few that do, and that is all your income here is taxable if you're a resident. So on the first blush, it may not be a great idea to be a resident and have all your income from all sources taxed, but we still hope it's a good country to live in. Okay, all right, moving on. That means that if residents are subject to their taxation worldwide, then the non-resident is subject to tax only on what we call U.S. source income. Where's the income come from? It comes from some United States source person or entity or school or scholarship program. That's going to be subject possibly to income tax, but that has to be looked at by a non-resident, not their worldwide income. So that's their concern is only what is U.S. source income to them. And then, of course, the question becomes, who's a non-resident? And we're going to get to that. Now, the concept of U.S. source income only here, by the way, I want to point this out early on, includes non-allowable F1 income. I get this question several times every tax season. Here are my papers to file my tax return. Could you help me out? Sure, I could. I'm not giving you this one because this one was not allowed. I worked, even though I'm an F1, it turned out I wasn't allowed to work there. I'm working that out with my visa, but that's not taxable here. It is. It's US. If it's US source, it's still taxable here. And that's what I want to let you know right up front. So when it says that the non-resident, that's you, F1 international student, U.S. source income only, it doesn't matter whether it was allowed under your visa or not. You don't have to worry about the income tax people getting upset that you had non-allowable F1 income. That's between you and the United States government visa people. So don't panic, just report it. That's the whole idea. Make sure you report it. Okay, who's a resident and who isn't? So the basic concept for our F1 students and J1 students, so we'll say F1 students and J1 if you're a student, is that you get 5 years from the time you arrive in the United States. You have 5 years where you are going to be considered automatically a non-resident. That means that you don't have to worry about being a resident for the first 5 years you're here under these visa statuses. Now, the 5-year rule works like this. It's 5 calendar years. It's not 5 years in terms of days, it's 5 calendar years. This is a typical scenario that we see every once in a while. Somebody arrived December 31st of 2000, let's say 22. That's year 1. Now they're here the next year, they're here just for a day. In 21, 23, they're here just for a day. So 1 day, that's year 2. So now they've been here 2 of the 5 calendar years, and I think you get the picture. So it's all about when you're here during the year. It's not about the number of days, it's what calendar years you're here. And if you're here 24, just to move ahead a little further, if you're 24, that becomes year 3. 25 would be year 4, and 26, any one day in the year, calendar year 26 would make it 5 calendar years. All during these 5 calendar years, you are not going to be subject to being considered a resident for tax purposes as long as you have the F1 visa. So that's the good news. It makes it easy for you to determine whether you're a resident for tax purposes in the US or not. Most cases, you will not be a resident for the first 5 calendar years you're here. And here's our first requirement, our first compliance. So while you're here, during these 5 years, these 5 calendar years, each year that you're here during a calendar year, from the time you first entered the United States, each year you will have to file a form to tell the US government, to tell the IRS, hey, I was here under my F1. This is year number 4. This is year number 3, whatever it is. So I am still a non-resident. That's what Form 8843 does. That is required each of the years of those 5 years that you're here. So if you do the following, just as an example, if you come here at the end of 23, even for 1 day, as we said, you'll have to file Form 8843. Now, let's say you skip out of the country at the end of that day and you don't come back until 2025. So for 24, you do not have to file the form, not required, because you weren't here. There was no use of that year. Not request says not required. But in 25, if you're here a day or more, then you're back to having to file the form. And this way, you're able to count up your 5 calendar years and you let the government know so they understand where you're holding in the 5 calendar years. And one more thing to be said about these 5 calendar years, is this is a one-time shot. It's one time. You start your F1, it's 5 calendar years from that point on. You get a new F1 10, 20 years later, doesn't matter. You've already used your 5 calendar years. So this is a once in a lifetime tax gift for you under these rules. Once in a lifetime.
So, Sam, to clarify, this
Yes.
means that when a student has fulfilled the 5 calendar years, if they're in F1 status, then they become a resident alien for tax purposes?
Yes, we practiced this before we started because that was my next exact slide. That's where we're headed.
Okay.
Good deal. All right, so you'll file this form those 5 years. When the 5 years are up, so there you go. Year 6, what happens in year 6? You are a resident. you're a resident. Now, before you look at, don't look at any of this for, right? Everybody's looking at it. I'll erase that in a minute. So the general rule is when you hit year 6, calendar year 6, you're a resident. There is one exception, and now we can look at it. And the reason I said don't look at it is because it's not likely to be you. But the one exception is if in year 6, and presumably years past 6, like 7, 8, and 9, if you're here less than 183 days in that calendar year, and you have arguably a closer connection to your home country, then you can still claim to be a non-resident. You have to send a form to the United States government and tell them that's what you're doing. You're using the closer connection, and then you can become a non-resident. Why would you want to do this? Well, you would want to do it if you, particularly if you have a lot of worldwide income that you don't want to be taxed here, and it's year 6, 7, 8, 9 for you, and you really don't intend to stay here. So the way you prove that you really don't intend to stay here on a permanent basis is you're not here in any calendar year after year 5 for more than 183 days or more. You're here less than that amount. And anytime you do like a step towards permanent residency, like if you go for your H-1B status, that will knock out getting the closer connection. So that's why I said don't look at the exception right away, because it probably doesn't apply to you. You're probably after year 5, you're probably going to be filing as a resident. And what should tell you is from a tax planning standpoint is just get ready for what would happen if in year 6 you're a resident and you do have significant assets, significant income worldwide. We don't have too many F1 students like that, but if you do, then you would certainly want to do some tax planning ahead of time to find out what the impact would be on you when filing as a resident. Sometimes it's not as bad as you think because we have lots of nice tax loopholes here in the United States. So it may not be so terrible. All right, but that's the issue with after the 5 calendar years. Okay, so what I want to do now is let's talk about what it means when you're a non-resident under F1. You're going to have tax from U.S. sources. However, the tax from U.S. sources has some exceptions. And here's the most common one, which I wanted to point out. Again, it doesn't happen a lot with people coming, F1 students, our international students, but just in case, if you invest in a U.S. bank, the interest from that U.S. bank is exempt from U.S. tax. It is a U.S. source. It's a U.S. bank, Bank of America, Wells Fargo. I have to mention CQ because they're on campus, and M&T, they're on campus too. So if you invest money there, even a small amount, you get some interest income, it will not be taxable while you're F1 during that 5-year period and you're a non-resident. So we're now going to abbreviate non-resident as NR. So when you're a non-resident, under F1, this is exempt, not taxable. And anything exempt by treaty. There are tax treaties with most of the countries. F1 visitors and guests come here to the University of Maryland. Most of those treaties have certain exemptions where I might say something like, well, this would be taxable if you have this, this will be taxable. And yet some treaties will exempt that situation. So there is a lesson to be learned here from my international tax professor years ago, who used to ad infinitum say to the point where I got sick of hearing it, but it was important, so it was a great lesson. And that is, you do all your international tax planning by reading the law, by reading everything, by regulations, etc. And then you always look at the treaty. That's the last thing you do. Always check the treaty, because there might be an exception in the treaty. So always check the treaty. And we'll talk about some treaty exceptions as we go along.
Sam,
Yes.
excuse me, 2 people using J1 visas have asked a question. The first one is, if they've used a J1 visa and an F1 visa, when they do their presence in the United States, do they add those years together?
That's a little bit complex to answer in the space of time we have here, because there are some rules that apply depending on which J1 they're talking about. But let me give you just a generality, and that is if you're here as a J1 student from the first time you get your J1 visa. The 5 years is the same as the F1. Same 5-year rule. There can be some exceptions. It's not normal, but there's a J1 for teachers, and in that case, there could be an exception to the 5-year rule the way we've described it. So I'll just put a question mark, could change that. But generally, the idea of the 5 years applies to F1 or J1 coming in as students. I hope that helps. Okay, and there's my slide, always check the treaty, just for good measure. All right. One more thing to point out is that while you may have U.S. source income subject to income tax, we really have two important levels of tax here in the United States. So you may have U.S. source income as an F1 that would be subject to income tax because it's U.S. source. But most, not most, all income that you might have as an F1 student would not be subject to FICA taxes, which is Social Security, and that applies for the 5 years. I'm going to illustrate this to help make it more palatable and easy for you to figure out where you're holding. This is not true for F2, etc. It's true for J1 and F1, but after that, J2s and all the other Fs and Js that come in are subject to Social Security tax. That's what FICA means, Social Security tax, and therefore this exception doesn't apply to them. This is how you would know. This is one of the forms that you're getting at this time of year. This is the W-2. The W-2 is if you worked for the school or some other allowable place for F1 students to work, or even not allowable, as I said, you're going to report income that's been reported on a U.S. W-2. And if it's been prepared correctly because you are an F1 in your first 5 years, then you will have wages here. There'll be an X here, and there might be some income tax withheld for your benefit, meaning they might take some of your earnings and give it to the federal government as an advance towards your income tax liability. If they overpay, you'll get it back. If they don't pay enough, you'll owe a little bit. But so this is really your money. Don't worry about the fact that it's been taken from your paycheck. It's just being sent to the U.S. government for your behalf, just in case you owe taxes. But they'll report in this box your wages for federal purposes, and they'll report the state amount down here with a similar amount maybe taken out for state income tax purposes. All that's well and good, but here's the issue when it comes to Social Security. If you're F1, first 5 years, all right, so let's set the stage. You're F1, you're in your first 5 years. There should not be anything in this box or this box. This is the FICA that we're talking about. These are the Social Security. Those should be 0. In the event that you work for the school, they will most likely, 99% of the time, be 0. No problem. The school knows what it's doing. In the event you work outside of the school, then you may have an employer who doesn't understand this, doesn't get the message. You may try to tell them the message before you work, which you should do. You should let them know, hey, I'm F1. I'm not subject to Social Security tax on my wages. Nothing should be taken out for that. They should be happy about that, by the way, because of these taxes in boxes 4 and 6, those are matched by the employer. So if you have taxable wages here and you pay a certain amount there, the employer pays the same amount. It's a payroll tax on the employer. So the employer should be happy to know they don't have to do that for you. You're not subject to the Social Security tax while F1. This is something that we see quite often during the tax season where F1 students have had the taxes taken out incorrectly, again, usually off campus. We have a form that we can give you which shows you what you're supposed to do. And there are steps you can take. You can and will get the money back. You can and will get the money back. You just have to go through a couple steps. Terp Tax can help you do it. All right, moving along a little bit more with the taxation for F1. There are tax benefits for education expenses, question mark. Why do I say that? Again, I always get F1 students saying, I heard I can deduct I heard I can make use of my tuition payments, my payments for books, and my payments for fees and reduce my taxes. And for F1 students, the answer is mostly for F1, not a chance. There are very few countries, treaties that even allow or come close to allowing any kind of deductions or education expenses or any things that you hear about from perhaps other students around campus. And I'm not even aware of any countries' tax treaties that allow it. So that's why I say not a chance. I haven't heard of one yet. One of these days I might find one, but I haven't seen it yet. So I pointed out to let you know, don't necessarily take as the Bible what you hear from other F1 students saying, I prepared my tax return and I got an education credit. Chances are, if they're in their first 5 years, their first 5 calendar years, they've made a mistake. That's the most likely chance. Okay, another one is that for residents, there is what's known as a standard deduction. For resident taxpayers, they might report, let's say $10,000, but the standard deduction is going to be about 14, leaving them with zero taxable income, zero tax to pay. That's what's known as the standard deduction, some number around like that for individuals. Great, except the standard deduction for F1 students does not apply at all, except for our students from India. That is in the treaty. That's why they get it. But no other treaty that I'm aware of allows for the standard deduction. So if you're from India, can go out and work in the United States without fear of having too much tax to pay. Again, you have to be on your first 5 years as F1, but you've got it made as far as reducing any tax obligation that you might have by a whole lot because the standard deduction is fairly robust. All right. Win a prize here in the United States, a US prize. You go to the racetrack. Well, people don't do that anymore. You go to the casino and you win a US source prize. It's probably going to be probably taxable. At what rate? Given what I see usually of F1 students and how much money they make or how much money they don't make, it's probably not taxable at a large amount. So don't get fearful, but you do have to report it. I think the most important part of this slide is you got to report it. The one thing in the United States you don't want to do, whether you're a resident or under F1, is underreport your income. That you definitely don't want to do that because the IRS doesn't like it, US government doesn't like it. They don't mind if you take a deduction you're not entitled to. They'll correct that, but they don't like it when you don't report the income. All right, that leads to a really interesting question. What if you have no US source income? What are you supposed to do? Well, we already learned about the 8843, which we're going to see again when we look at the forms so you can see what your obligations are. We're going to look at those. But the 8843, which tells the IRS, the US government, if you're F1 and if it's 5 calendar years, where are you? That's what that 8840. So that has to be done every year during that first 5 years. But what about the income tax itself? What if it's your first year here and you file your 8843, like we just said, but you didn't have any income from US source? So what happens then? According to the instructions, you don't have to do anything. You don't need to file an income tax return. And the income tax return for the non-resident is what's known as a Form 1040 non-resident. Again, well, I'll show you a picture of that, but that's the form. But if you have no US source income, you don't even have to file it. However, let me say that again. However, Mr. Handwerger here, that's me, believes that your best bet is to file what I call a protective filing, a protective return. And that would be to file a zero return. Because that will show the Internal Revenue Service and the US government and the immigration people that you attempted to comply with the US tax law. What I'm getting at is suppose you don't even know of any US source income in the year we're talking about, let's say 2024. You're not aware of any US source income. So you do your 8843, but you don't file a tax return because the instructions say you don't have to. However, unbeknownst to you, there was somebody who paid you something that happens to be taxable. It's U.S. source. You didn't know it was taxable. You didn't know you had to report it. Could be very small, but meanwhile, you didn't even know about it, or you didn't think about it. You assumed it was not taxable. You assumed it wasn't even U.S. source income. You made a mistake. You didn't do it deliberately. If you file a zero return, it shows the IRS, hey, I thought about my income tax return. My interpretation was it was zero. What are you going to do about it? I made a mistake. Let's correct it. And I believe this concept of the protective filing, protective return will be very efficient in the event that you wind up having made a mistake and you were supposed to file an income tax return. Even if there was no tax, at least you will have shown that you attempted to comply, you thought about it. There's a basic concept. I'll pause for a minute and give you an insight. There's a basic concept in the professions today, and I'm in the profession, so I'm very aware of this, and that is it's called no ink, no think. They used to even say it in court. They don't say it anymore. Basically means if you didn't put something down on paper, as far as we're concerned, you didn't think about it. You ignored it, or you didn't even know about it. You were ignorant, which is not a good thing. Ignorance of the law is not good. So the protective return falls into this category of, here's what I thought. Oh, later on, somebody looks at it, you made a mistake. It was a professional mistake. Okay, that happens. Professional mistakes are somewhat and oftentimes excusable, but ignorance of the law or negligence is not. All right, so that's my idea of a protective return, to file a zero return.
Sam,
Yes.
we have a clarifying question from a student who's asking, is the country of India the only country that can use the standard deduction?
That is absolutely correct.
Okay.
Yeah. I'm not aware of any other tax treaty that allows for that. In fact, I would say that based on the fact I've been doing this for about 8 or 9 years, I think I've seen all the treaties out there. Nobody has it except India.
And one additional question was, we've had a couple of these come up. People who have perhaps not filed in the past, so they feel that they've neglected their tax obligation. How do they go about correcting that situation?
Okay, so I would say it's an easy answer. File all back returns. There's no statute that says you can't file something that's 5 years, 10 years, 15 years old. You can file anytime, no matter how many years it's been. You may not get the refund. There's a statute of limitations on if you'll get a refund, but if you made a mistake or you didn't even know or you weren't sure, just go ahead and file all the back returns.
And is that something Terp Tax could assist a student with?
We can go back right now. I think we can go back to the year 2018. If you have to, we've had to go back further than that on occasion, in which case we go out to the marketplace, we pay $20, $30 to rent some old software system and we get it done. Yes,
Thank you.
no problem. Of course, that fee is passed on to the student because we're nonprofit, but you get the idea.
Mhm.
Yeah, that's a good question. All right. Okay, due date is April 15th. There's an extension. If you file for you have to file for it. You file for the extension, you're going to have a due date of October 15th. This is for the 1040 NR. And filing the 8843 in the event that you don't include it with your 1040 NR, because you can do that. You can include it with the 1040 NR. You can e-file it that way. You can electronically file it. Or if you don't, it's due by June 15th. You can mail it in. You can just sign it by itself and mail it in by June 15th. That's its due date. There is no extension for it unless you have filed an extension for your 1040 NR, in which case then you can file the 8843 anytime. And here's another example of that question about what if I didn't do it? What if I've been here 4 calendar years and I never filed the 8843? Just go ahead and file all of them that you didn't file today. Go file them now. It's no penalty for being late on the 8843. There's no tax due. It's just an information return. There's no penalty for filing late. If you file a 1040 and are 5 years after you were supposed to file it and you owe taxes, then you may have some interest and penalty to pay for lateness, but it's still better to file it and pay it and be in compliance. Good questions. Okay, we're going to follow up with just a few more slides, and then we're going to get back to the forms and then take a bird's eye view of a few last things. But I want to let you know, once a resident, your worldwide income and worldwide assets are subject to income tax and reporting. So I had mentioned this before, and what I'm getting at is I think that it's now time for all of us, the F1 students and Terp Tax itself, and I think I'll start something, an initiative this season where we will be ready and open to counsel those F1 students who may be in year 4 or 5 and are looking at still staying in the United States. We hope that'll be good. And then we have to deal with you under our regular tax system. It'll be wonderful to be able to sit down and say, okay, in your case, your projection of what you're going to be doing here in years 6, 7, and 8, not a problem. Or in your case, years 6, 7, and 8, here's some issues you have. Here's how we would recommend that you approach those issues when transitioning to the resident status in the U.S. I think that's a good idea. I didn't even think about that before that. I just opened up my big mouth, and now I've announced an initiative that Terp Tax is going to do. But I think it's a good idea. I really do. Okay. Even after you pass the 5-year mark, so after 5 years, you may still have some tax treaty benefits available to you, even though you're going to be a resident. We have one with China, where there's a $5,000 exclusion from earnings, which can be available while you're under CPT or OPT. That tax treaty is not does not only apply to non-residents, it applies to residents as well. So you could be here year 6, 7, 8 as OPT or something, and you may still have that exclusion. And there may be other exceptions where you still have that treaty benefit. And there are others like it. It's not just the China. So, but that's the China treaty. All right, I'll come back to this later, but this is my commercial. Terp Tax has a website. You have this year, we have an option. We had it last year as well. You can actually self-prepare your return. You sign up and we'll answer questions. We'll be there to help you, but you can actually self-prepare it. That's one option. We can also do complete tax return, and we tell you what to upload and how to go about doing it. So you can make appointments. We're going to have more appointments. We already do. We have more appointments than ever before. There are, just for argument's sake, let's say 3,500 F1 students on campus. Last year we did almost 1,000. This year we could probably have a capacity to do 2,000. So don't hesitate for you, your friends to sign up. You don't have to self-prepare. You can ask us to prepare it if that's easier and better for you. Volunteers will be standing by.
That's great, Sam. Can Terp Tax assist the students who may have filed as a resident in a prior year and would like to amend their return to non-resident?
Absolutely. We might have to do that after tax season, depending on how busy our volunteers are here. But you do have time to file that amended return. It's not an issue. You already filed a return. Incorrect, it is, but you have time to make the amendment. There's generally there's no specific window of time you have to make these corrections. But I would say if you make it within 2 years, you'd be considered to be in full compliance. Nobody would get upset. It is a common mistake made by F1 students, very common.
And we have a couple of different questions about tuition money where perhaps relatives are providing tuition money to students in a bank account, and do they need to be considering that as income?
Oh, wow. Okay. What a question. Gee, I wish I was prepared for this.
Yeah. Well, we can always have people go to Terp Tax, and that could be something that can get answered.
Well, here's the joke. I have a slide already for you.
Oh, okay.
I wish I was prepared. Here it is. Here's a slide. I made this slide in 30 seconds. My parents send me money from abroad. to pay for rent, food, whatever, even maybe tuition. Is this income tax for an F1? We're talking about F1, non-resident now. Let's get that straight, non-resident. And it's a question of gift versus income. Gifts are not taxable, even if they, and in your case, they're not even US source. So, because it's coming from overseas, so it's not US source. And even if it was coming from a US source, gifts are not taxable. It's not taxable income.
Great.
So all I want to know is if you're getting significant money from family, let me know and let me talk to them and see if I can get adopted. All right. There are reporting requirements. This doesn't happen too often, but I thought I'd throw this in just as for good measure. There's reporting requirements for large gifts. In the event that you get gifts from individuals or an inheritance from somebody who, God forbid, passes away, if it's more than 100,000 to you, it's not taxable. It's a gift. It's an inheritance. That's not taxable to you. But there is a reporting requirement where you have to report that you received this money as a gift or as a bequest from someone who passed away. And you would file Form 3520. Again, it doesn't happen too often. It's 100,000 in any calendar year. So it's for a calendar year. And you would file it once a year to report if the gift went over that amount during the course of the year, either in aggregate or in one lump sum. So it's a calendar year. And you do that, basically all you're doing is telling the government, hey, I know this money got deposited in my bank account, but it's not taxable income. So if you're looking at my tax return and wondering where's this 100,000, here's why. This was a gift. I won't give you all the gory details, but it's kind of an important form to do if you are subject to receiving such a gift. I have defended, not necessarily successfully, who received lots of money from overseas, didn't use the Form 3520. They didn't know. They didn't know about it. They didn't do it. And the government wants to know, was it taxable? What was the source of it? Was it legal money? Was it drug money? And if you can't prove, because it maybe was so long ago, the government will seize about half the amount. I've seen that happen. Not a pleasant result. All right. Any other questions out there before I do a summary of everything?
Yes, we've had some particular types of income and have reporting questions on them. Sales of real estate when the real estate is held abroad, and also dividends from stocks. And how would that be handled in a tax situation?
So real estate outside of the US is not US source. Not US source. And so it would not be taxable here as long as you're a non-resident. Once you become that resident, don't forget, that's worldwide taxation. Doesn't matter where it comes from. So as a non-resident, I'll put NR, it's outside, not US source. As for dividends from stocks in the US on US exchanges, a US exchange, that would be taxable here unless the tax treaty with your country says otherwise. So it will be taxable here. And oftentimes the dividend, when paid to you, will have the tax withheld by the payor. So you won't even have to worry about it, but you do have to file it on your return. You will have to show it on your return. So that is likely to be taxed. Interest from banks, we said, is not likely to be taxed. It's mostly tax exempt, but it's likely to be taxable. All good questions.
Mm-hmm. We'll be working through the definitions of various forms later on in our presentation, Sam, is that correct?
I'd like to do it right now if it's okay with everybody.
They're ready.
All right, here we go. All right, so you're going to have some of the income that you would have from US sources that are going to apply to a non-resident return would be the wages from on-campus employment. Scholarships and grants may not be taxable, but it'll be something you may have to report on the 1040 NR. Off-campus employment, we spoke about, oftentimes CPT or OPT, you will have to report that off-campus employment income So these are all and investment income, the dividends that you mentioned, and royalties, rental money from U.S. properties. Perhaps it's very rare, but it could happen. All that has to be reported on the 1040 non-resident return. Here's the copy. Here's what the W-2 looks like. We looked at one before, but this is what these are the forms. Now you're going to see the forms that you want to be collating for purposes of filing your return. They all may not apply to you, but these are the ones that could apply to the F1 students. So your W-2, which would be on-campus employment, off-campus employment, will show taxable wages, both at the federal and state level, any income taxes withheld for you. And again, as F1, first 5 calendar years, the line items here should be 0. If they're not, ask me for the, what do you do to get the money back? Because any money that gets withheld here, you can get back as a refund. That's the W-2. Then you may be getting a 1042-S, particularly from the University of Maryland, had you been subject to either some non-taxable income paid by the university to you, could be for a scholarship, could be a fellowship, could be income that you earned as a researcher. There could be numerous reasons why the income was paid to you, but not reported as being paid on the W-2. In fact, for example, that China treaty we mentioned with the 5,000, you would wind up having, let's say you earn 20,000 as a TA. That's a lot of money. Let's say you earn 20,000 as a TA. They'll report, the school would report 15,000 here because the 5,000 of the 20 was not taxable under the treaty, but they'll show you getting the 5,000 on this form here, which is called a 1042-S. This form will report income that doesn't show up to you from any other forms. It'll show up here, and then they'll have an income code, and they'll tell you whether it was exempt from tax or not exempt from tax. The payor, in this case, makes that decision. The payor makes the decision. If it's subject to tax, there may be a withholding amount, which again will be on this form right there. And that amount will show up on your return as having paid the tax for you regarding that income. If it's not subject to tax, the amount will show up, but there'll be no tax here, and they'll say exempt, and they'll tell you why it's exempt. There'll be codes explaining why it's exempt. And the payer's information here and your information's here. And this 1042-S is a real important form for most of you, because most of you are getting some type of tax treaty benefit from some payer, either the school or a tuition payment of some sort or scholarship. So many of you will be getting a 1042-S. And so the last I understood is that the university gets those out somewhere around mid-March.
Yes, I believe it was around March 15th before students will see their 1042-S.
Yeah, so you can do all of your tax preparation except for filing it, because you need to get this and put it on your return as well. Whatever this is, even if it's not taxable, you still want to include it in your return. So that's another. So you got 2 important forms, W-2, 1042-S. Moving right along with more forms that you want to collate for your return would be the famous 1098-T. Famous because for just about everybody here, you're paying some kind of tuition amount, and this is going to report how much you paid to the University of Maryland. It will also report how much you received in scholarships or grants. And let's take a second to understand what all this means. The box 1 will be how much you paid in tuition, so we'll call that N. Box 5 will be how much you received in scholarships and grants, and we'll call that M. If you do the math, an M minus N, the scholarships minus your tuition is a positive number, there is a chance that you have received taxable scholarship income, and that would need to be reported on your return. There's a chance. The treaties, in many cases, will come along and say, okay, it's not taxable under our treaty. Many treaties do that, but there are some of my best friends from F1 here at the school come from countries with no treaty, in which case it's going to be subject to the regular rules, and the positive number derived here would have to be reported as taxable income. Either way, it's got to get reported on your return So even if it ends up it's not taxable, you have to show it and then show why it's not taxable under the treaty. Your return will just list the treaty benefit by the article in the treaty. It'll list that. If M minus N is a negative number, then the opposite happens. You do not have any taxable income to worry about. It's like considered a zero, and you don't have to worry about your 1098-T. And particularly since this doesn't qualify for our F1 visa students for any kind of tax benefit, you really don't have much to do with the 1098-T. So the first thing you want to do is just take a look at the difference between good old box 5 and box 1, and just to determine whether you even need to bring the issue up with anybody to inquire about what you might need to do about it. Sometimes allowable under the F1 visa, or not allowable, you wind up working as an independent contractor. And you should receive, if you're working as an independent contractor, you won't receive a W-2. So it'll be no, let me write that the right way. There'll be no W-2. However, you should receive this from the quote unquote company that paid you as an independent contractor. And this applies if the amount is $600 or more. In the event that you got less than 600, they don't have to file it, but they should be giving this to you if you were treated as an independent contractor. I see that a lot, treating people as independent contractors for internships, summer internships. There is a lot of people who will pay you as an independent contractor or tell you they're going to pay you that way, and they are not following the law correctly. So just because you're being told you're an independent contractor, you might want to check with Terp Tax and just have us give you an opinion as to whether that is correct. It's not truly your problem if they pay you incorrectly, but you would probably be best served to know ahead of time before they start doing it. If you're F1 and you're paid as an independent contractor, it's not the end of the world for you. You will just report it the way they've reported it off the 1099 NEC. But just for purposes of education, you could certainly check with us to see if the payor is correct in treating you that way. This won't apply to too many, but just in case, if you get a 1099 miscellaneous information, that you also want to bring, because they'll have certain income that was paid to you by people. Again, we don't have this too often, but I want to mention it in case you see it. Don't throw it away. Use it when you do your tax return. We talked about dividends. Dividends in many cases would be considered taxable in here to U.S., and this is how that'll get reported to you on a 1099 DIV. The brokerage houses will have a substitute 1099 DIV, but it's the same information. And the neat thing about forms like this or forms like this, you don't have to get scared, because the tax software will just ask you to put in box by box, and it'll do all the work for you. Or Terp Tax will do the work for you. Okay, this is what the 1040 non-resident return looks like. This is what your goal is, where it will show income from whatever sources they were in the US sources. It'll show your name, address. Here's one thing that's kind of almost silly to say, but it's very important. Make sure that the address used by you when you file, or Terp Tax files for you, is the address you are expected to be at for the next 6 to 12, 18 months. Because if the IRS sees something, they will say something, but let me say this, let me start this again. I like what I'm going to say here. It's the first time I can use this expression ever. If the IRS sees something, they will say something, but it could take them a year or 2 years to say it. That's the problem. So you want to make sure you're getting your mail, and that the IRS has a current address. If you do move after you file your return, then make sure you have a forwarding address. And in the event that you're having difficulty doing a forwarding address, there is a form you can send to the IRS telling them about your change in address. You can send a form. All right.
Sam, we have
Yes.
several questions about private student loans and if the money coming from a loan is considered taxable income.
Loan is not taxable. So that's good. So let's make a slide for that. I wasn't ready for that one, but loans are not taxable when you receive the loan. I'm going to make you all tax experts now by giving you one more piece of information. If the loan is forgiven in the future or at any time, someone says to you, oh, you don't have to pay me back, then it's taxable.
Mm.
Now, it would have to be from a U.S. source for the non-residents for us to make even any difference, but just as a general guideline, that's the story with loans.
Okay, thank you. Does Terp Tax assist the students with a preferred method of submitting their tax forms electronically or by the mail?
So Terp Tax says that your best bet is to file electronically. That way there's a record that it was done. And in the event that the electronic filing on the other end, meaning the government end, somehow has a problem, you should have very little issues of penalties or interest because we'll be able to show them, here's what our records show. We filed it on such and such a date. The fact that it got filed up somewhere in the system electronically, but that would be your safeguard. If you mail a tax return in and you don't mail it a return receipt, which is a way of mailing things through the post office, you actually go to the post office to do it. If you just put it in a regular mail, you have no proof of mailing, so you don't have that protection. If you do have to mail something, then, and it's an important piece of paper, do it through the post office with what's called return receipt, where the receiver has to sign for the receipt of the envelope, and it gets sent back to you. And so now you say, look, on such and such a date, I sent you an envelope. In that envelope was my tax return, and that's what you have to go through.
And individuals are responsible for retaining copies of their tax returns.
Oh, yeah, that's a good point. You want to retain your records for approximately 4 years. Record retention, keep for 4 years. That's a really good question. And the tax preparer is also required to keep a copy, but that tax preparer is not Terp Tax because we're not paid. We do keep copies, but we are not bound by law to it. If you pay somebody, they're bound by law to also keep a copy or return, but we keep the copies in a safe place as it is in case you ever lose something.
So a student who has a student loan from a foreign country, there is no tax impact on that loan.
That would be correct. A student loan from a foreign source would not have any impact in the U.S. While a non-resident. Even while resident, it's not an issue because it's a loan. It's not income. It's not, if it's forgiven, that becomes the other point that we were making before, if the loan becomes forgiven. But when the loan's made, it's not considered income. Now, by the way, if you get scholarship from outside the U.S., that's not a U.S. source amount for non-residents, so that's not an issue either. That's why you'll see in every treaty little language and little phrases in there that when they talk about scholarship, they only are talking about scholarships from within the U.S. For the non-resident here. If it comes from outside the U.S., even if the scholarship comes from an outside source that goes to the University of Maryland in order to pay your tuition, it's still not taxable to you. It's coming from an outside of the U.S. source.
Thank you.
We are now officially in our Q&A time, so everybody should fire away.
Let's see. There's been a lot of interest in the idea of a standard deduction for the people of India. And so there's questions about what is the amount of this standard deduction? How does it get applied?
So let's do a quick survey of how the tax system basically works, the tax formula, as we call it. So for a non-resident, the formula is U.S. source income, add it all up, put it all down, add it all up, take out any deductions that apply to you. And we'll get back to this part in a second. Take out any deductions that apply to you. So you take this minus Y and you get what's known as taxable income.
Mhm.
Then you apply the tax rate to this based on a graduated scale. We live in a progressive tax system, which means the more income you make, the higher percentage tax you pay. So then you look at the rate times the taxable income will give you your tax liability, how much tax you owe. Okay, so fine. So the question then becomes, well, what deductions apply to a non-resident? And the answer is that mostly none. There aren't too many deductions that apply to non-residents. It's just the nature of the way that works for them. However, if you are from India, one of the deductions that applies, which is within this category, is called the standard deduction. And I don't have the number right in front of me this minute, but it's close to. So I'll say, I think this is the mathematical symbol. It's approximately 14K for a single individual. If you're married, it's probably close to $28,000. So you can begin to see that as a single individual, F1 non-resident in the United States from India, you've got plenty of leeway to earn U.S. source income without having to worry about actually having taxable income here, because this number, this Y is going to be 12,000, or I mean close to $14,000 subtracted from your income. So if you make 20,000, all right, you'll be left with maybe $6,000 of taxable income, but that'll be at a very low tax rate. And so you've escaped a lot of taxes by having that standard deduction.
And in our Q&A, we have several questions that are on various types of interest income, whether it's high yield or the dividend income again, or interest income from the bank. And I guess an explanation of how this plays into U.S. source income would benefit people who are asking these questions.
Wow. Okay. We haven't had these questions ever. That's great. Okay. All right. So U.S. banks and most financial institutions, U.S. financial institutions, paying what they will call interest. So if they pay a yield to you, whether it's high yield, low yield, fraudulent yield, a Ponzi scheme yield, whatever it is, if they pay some interest to you and they call it interest, and you are a non-resident, F1, you can pretty much say it's not going to be, it is U.S. source, so you'll put it on your return, but it'll be deducted as being exempt from tax. It'll be shown as exempt, not taxable. That's interest. Not true for me because I'm a resident, but that's the idea. So the idea is that U.S. banks, U.S. financial institutions, their interest payments, so it'd be interest, that's the key. It's going to be labeled as interest, and it'll be on a 1099 INT. That's not going to be taxable here in the United States. Think of it this way. Think of the theory of what the United States is doing. This will help. The United States is trying to encourage capital coming to our financial institutions, our banking institutions from around the world. So maybe we don't have the highest rates in the world, but we have safe banks, and we'll promise no taxation on the rates paid of the interest for you. So it helps attract a lot of money from overseas. However, if you buy a stock that is yielding dividends, and it's a U.S. stock, it's a U.S. company, it's on a U.S. exchange, U.S. I should say company, U.S. stock exchange, and it pays you dividends, and you sell it for a capital gain. So you have a capital gain when you sell it, you get dividends in the meantime. Those most likely will be not just U.S. source, because it's a U.S. company, it's U.S. stock exchange, so it's U.S. source. It will also be taxable. However, so I'll say and taxable. However, the rate on that tax is check the treaty, because if you're from Canada, it'll be 0. it's US source, it's taxable, but then you got to check the tax rate to find out what rate of tax you have to pay on it as a non-resident. Again, don't forget, we're always talking about here non-resident. Capital gains may also be subject to a tax, but at a lower rate because of the treaty. So check the treaty applies for both dividends and capital gain. We see a few of this sometimes with cryptocurrency. And if the crypto is being done on a US exchange here in the United States, then it's the same rules are going to apply that you see here.
Right, we have several questions where people have transitioned to being resident aliens. So if I remember from our earlier discussion, there's a future session for resident aliens coming up in March.
I don't know if I did that or not. I just know I said here today whether I was actually being cognizant or dreaming, but I said that Terp Tax is going to have an initiative to have sessions for people who are transitioning to resident. It's really, I think the time has come where we start to address that with our students. So I don't know if Debbie has something set up or if any of the other.
I think we said there was something coming up in March, but if we go to the Grad Legal Aid website, we should be able to see the session schedule for future sessions.
Okay. I might have been daydreaming, dreaming, or actually saying the truth. I don't remember, but it just occurred to me that I haven't done that in the past, and I think the time has come where we give our F1 students, our international students, the courtesy of saying, okay, you're going to become a resident. What does this mean, and what do you have to do?
Someone is asking if there is a tax benefit for an F1 non-resident to make IRA contributions.
That's a great question because it is something that for residents, it's certainly a way to reduce taxes. It's a very valuable methodology. However, it will not apply to non-residents. Sorry for our non-residents. Yeah. After all, we're encouraging the tax law is trying to encourage U.S. residents to prepare for retirement. For our non-residents, we're not thinking that you're going to retire here, so we're not encouraging you to do that through the tax law. It doesn't mean you can't stay. It just means the tax law didn't anticipate that you would need that type of tax incentive to prepare for your retirement.
We have revisiting of the gifts from family. So are gifts from family taxable?
They are normally not taxable. So I would say, in fact, I would say it applies both to residents and non-residents. Gifts are generally not taxable. There is a possibility that someone gives you their IRA, and that might be taxable to you. But that's not the normal gift. We're talking about gifts that are normally not taxable at all for both residents and non-residents.
And again, people interested in maybe there were some forms left out in prior tax years, and they're concerned about not having those forms properly filed with the IRS. And how would they go about amending any tax returns?
Okay, so let's talk about that in a broad sense. There is a concept of an amended return to correct for mistakes in prior years. An amended 1040 NR or resident return. It can be done. It's done on a Form 1040X, which sort of sounds like it sounds. It's for fixing something from prior year. Some fixes are very easy. For example, in the event that you had filed a 1040 resident and you were supposed to do this, the 1040X anticipated lots of that happening, so they make it very easy. They tell you exactly what to do to make the change, and it's fairly simple to do. You still need a Terp Tax or a software package to help do it, but it's fairly easy to fill out the 1040X. If you left off a form, sometimes when you have looked back and you say, oh, I forgot this, I forgot that, one of the first things to actually do is, okay, so I forgot something. What's the tax effect? It could be that the tax effect is 0, in which case you don't have to do anything. You don't need a 1040X. No need. If the tax effect is you're going to get money back, you certainly want to do that. If the tax effect is you owe something, you certainly want to do that. But many times students come to us and they forgot something, and we look at it, but it would have had no tax effect, and so you don't really need to do anything about that.
I have a question about an interest income from the bank, and
Mhm.
it's, the person is saying it's already been taxed and they get it back. Is that-
If they, you mean they had tax withholding, or they reported it as taxable?
I think they believe that they had tax withholding.
On a 1099 INT from a US bank? So
They're
if,
not that specific.
all right, well, what I would suggest is to have, how you can have Terp Tax take a look at it and determine whether or not it should have had tax taken out. A lot of times what happens is, and particularly with an international F1 student, is you can go to a bank and you can put money in an account, and if the particular person you're working with isn't quite, let's say, knowledgeable enough or savvy enough to think about what the repercussions are of you being a non-resident, or doesn't even realize you're a non-resident. You have a social security number, you put that down, and they just think you're just like every other resident, and so they put you down. Something like this could happen. And so this is a great question, actually. What students should become aware of is that they open up bank accounts or brokerage accounts, they need to start being aware of the W-8 series of forms to give to the bank, to the brokers, which will tell them whether or not they should have taxes taken out of the income that they're going to be paid based on their investment. So there's a forms W-8 series, and I don't have all the memory banks in my place of which each one is, but there's a whole, not a whole, there's maybe 3 or 4 different W-8 forms that you can give to these kind of payors to tell them what to do with it. It tells them you're non-resident, tells them whether you're subject to tax on it or not. And that's something that's probably, maybe I'll get a memo out for us to put on our internet site, our websites, about that.
Right. There are students on F1 status who hold assistantships, and as part of that assistantship, a student receives a tuition benefit. So they are getting a tuition remission. Is that taxable?
Again, it goes to the 1098T. Let's see if I can find a copy of that. That's where you're going to find that information. I think here it is. And so basically what you're doing is your tuition assistance, your tuition remission is going to show up under scholarship or grants. The amount of tuition paid is going to show up there. And now your concern is whether or not the total of box 5 is greater than box 1. That's your concern. And if in the event that it is, then your next concern is, okay, well, does that matter to you? Is there a treaty provision where that doesn't count? That doesn't matter. Many treaties do have that as an exception where you don't have to worry about it, but you would still want to know. If you're from a country without a treaty, then you're definitely going to be wanting to know what's the difference between box 5 and box 1 to determine whether you have an issue. And let me just elaborate a little bit on it. The concept is the following. If box 5 is more than box 1, it's an indication that the scholarship, the fellowship, the grant was covering not just your tuition, but covering some non-deductible, related to the school expenses like room, board, spending money. There are grants out there, there are scholarships out there that give you some ability to have some spending money as well as room and board. That would make the possibility, if you're getting any of this, as being taxable because it's really to your benefit. Again, with many treaty exceptions.
Mhm. And when a student has a loan, a student loan, is there any exemption for the interest paid on these loans?
So when you have a student loan, while you are a non-resident, there may be a couple countries that allow for student loan interest to be a deduction. There might be a few out there. So that's student loan interest, I'll say deduction, which reduces your taxable income. There are maybe a few exceptions, one or two, that allow that. So as a non-resident, you may be able to deduct it, but again, most likely not. And it would be something to check with the treaty under your particular country. Now, if you become a resident, this goes to that concept of the initiative of meeting with our transitioning to resident status. If you go to being a resident and you still have the student loan, in those years, the interest will be deductible as a resident. So now it would be yes.
We had a little bit of, well, language confusion about the non-resident alien and resident alien tax session. The March session says it is a session for domestic students, not resident
Right.
alien tax.
Right.
Is
that's
there a difference?
Yes, that's not for you until you become a resident. That particular session is for people who are residents today. And it doesn't have anything to do with people who were F1. It's just strictly looking at you as a resident today. So I think that says to that this idea, uh, you're not old enough for this by any stretch, but I remember Jackie Gleason, the old TV show, and he used to say at times like this, you know why I'm going to have to do that seminar on transitioning from F1 to resident? You want to know why I have to do that? Because I got a big mouth. That's what he would say. And that's because I opened up my mouth and came up with that idea. So, but I think it's a really good idea. So we're going to try to get that on the agenda. I think what I'll also do is we'll try to put together some type of brief elementary memo on the issues and get that posted on the websites and just have that sent out to all our F1s as much as we can as a forerunner to this an upcoming seminar.
So if an F1 student has been in the United States long enough to have become a resident alien for tax purposes, the session for that says domestic students would not apply to them.
Not really. That's not what I have in mind. Yeah.
Okay.
Yeah.
Very good. Thanks for clarifying.
Yeah, no problem.
Then we have a couple of specific questions about that are like case studies. And we have about 3 case study types of questions, but here's one. This is an interesting one, Sam.
Uh-oh.
What form are capital gains from stocks or cryptocurrency declared on?
Oh boy. Okay. So that's a mouthful, and there's 2 parts to that question. Capital gains today are reported on a 1099-B form. It's the brokerage houses, the banks will give you that form. For crypto, right now, some of the exchanges are using a 1099-B to report, but starting in 2025, after this calendar year, that is, and you'll get it next year for 2025 transactions. There's a new form coming out. It's a 1099 something. I forgot what the IRS is calling it, but it's a form just for crypto. So starting this year for next year's tax season, you'll get a form And you'll only get that form if you're dealing with a crypto exchange that is trying to be transparent, above board, and recognized, and be a good sport and playing the game of they want to be legitimate. There are some that you can probably find in the deep, dark, bad web or places like that where they'll be glad to handle your cryptocurrency, but there'll be no reporting. So it's still a little bit of the wild, wild west, but we will see a lot more compliance reporting in 2025. Glad you asked that question.
And before we go,
I got lonely. I have to see everybody. Okay.
yeah, before we go, one person has just asked us to try to go over the forms that F1 students would have to file.
Oh, okay. Let's do that one more time. That's a good idea. That's a good way to, I think, end the session is to
Mhm.
that. So let me go back to sharing and we'll do that. We'll go over what these forms are. Okay, so let's go back to almost to the beginning. The first forms I'm going to show you are the ones you want to collect for purposes of preparing your return, the W-2. You may not get it. It may not apply to you, but these are all the ones that could apply to you that you want to make sure you have. W-2, a 1042-S. Again, we've said that it probably comes out mostly in mid-March, so you probably don't have those yet. Your 1098-T about your tuition and scholarships, which is box 5, not to forget that. You would want to also collect a 1099 NEC in the event that you were paid as an independent contractor by somebody. They should file that form, and you should get a copy of that, like the W-2 and the 1042-S. You would get copies of that. This may apply, probably not. I would say this would be unusual. And then the 1099 dividends in the event that you have money earning dividends or capital gains. This would be something that would apply to you. And here's the 1040-NR, which is your goal is to file something looking like this. We also have the second page here of that 1040-NR. And then somewhere along the line, I showed you a picture of the 8843. Let's find that. Here is the 8843. This is the one that you want to file every year. So as a great denouement to this here seminar would be to say, last but not least, make sure you file this every year, even if you have no income and even if you don't subscribe to the Handwerger protective filing theory, which is just a theory, it's not law. Don't forget to file this during those first 5 calendar years you're here as F1. It's not hard to fill out. If you're not following a regular form, there's a place to mail it that's in the instructions. Mail it in. One a year. If you had forgotten, go back, get the old ones, file them. There's no penalty for late filing. Just file them. So someday when you're applying for your H-1B or your green card or whatever it is, if somebody decides that they want to see if you were compliant with your taxes, you can rest assured that you did the minimum of what you need to do. Let's see, I think that was the last form I had on here. Oh, there's a Schedule OI with a tax return. It's required for a non-resident. It's not hard to file. Most software will do it automatically, so I didn't spend a lot of time on it. But there is this other information just says, here's the most important part of this form. It will say when you came into the country and things like that, but that's not that important because it's going to be on the 8843. The most important part of this form, this is kind of an interesting one, which goes beyond the scope of what what the seminar was supposed to be about, but it's not a bad idea, is A and B. A says, what country are you a citizen of? So you might write down China. Let's see, it's hard to write it in that large a font. Let's reduce it. So you might write down China. That's where I'm a resident or a citizen. You're a citizen of China, if there is such a thing. Then B says, what country did you claim residence for tax purposes during the tax year? In that case, most of the answers are going to be China because you're not claiming tax residence in the United States. So usually it's the same answer. And this also tells the software tells the IRS what country you can use for tax treaty benefits. That's what it helps answer. It answers which treaty should you be looking to for your tax treaty. That's the basic importance of the OI. Other than that, it's just information. It's not a tax form, it's an information form.
Mhm.
I think that's all the ones I had here. Yeah, I think that was it. Okay. 8843. Well, we should leave with that picture in mind. That's how we should do it. There you go. Oh, 1040 NR. Oh, I don't know. I lost it. Whatever. All right, don't forget 8843. That's what I teach the volunteers at
That's
Terp
right.
Tax. Don't forget the 8840. Here it is, 8843. Don't forget that. Whatever you do, I teach them. Don't forget that.
And the 8843 is being filed for the tax year that you're filing for. So people who came in the fall would be filing the 8843 for the prior year.
For 24. They file for 24. If you came in January this year, it'll be you only have to file it next year for 25. One per year. One per year.
Anyone who had a case study type of question, I referred to Terp Tax so that we may see your advisors getting in some of our case study questions that came up in the Q&A, Sam. Thank you
Okay.
for
No problem. Thank you, everybody, for being here and being patient and some excellent questions. I think this year, more than ever, I must have done a good job because I have no idea what I said. I don't even understand it. So I must have been doing okay.
Sam, you were terrific as always. And Sue, you too. What a great team you make.
It's a
Um,
great
I-
team. It's a great team.
I hope students feel a little better prepared. I know we may not have been able to answer every single question, but remember, we are going to share all the resources that we talked about today. So you can go to Terp Tax, you can go to ISSS, and there is lots of help for you to help you survive the tax season. So thank you everyone for being with us today. It's always good for us to spend time together. So remember to complete that post-workshop evaluation. We want your feedback. We need it. And have a good week. And let us know how legal aid, ISSS, and Terp Tax can help you. Thanks.